All right, for more now, let's bring in Bob Michael, head of global fixed income strategy for JP Morgan Asset Management, and Lori Calvasina, head of U.S. equity strategy for RBC Capital Markets. Bob, first to you. I know that's a contrarian call by Scott. Do you agree or disagree?
No, I don't agree with it. Not when you have monetary, fiscal, and healthcare responses firing on all cylinders and creating an acceleration in the economy. We're looking actually for a very different round trip. We came into 2020 with a 2% 10-year Treasury yield, and we think we're going to exit 2021 with a 2% 10-year Treasury yield. And I think that better reflects all the policy responses we've seen.
I guess, Bob, that Scott's point, I don't want to speak for him, I'm just sort of summarizing the interview, was that all the stimulus money is going to go, even if it goes into a checking account, will impact things like T-bills and whatever, and the Treasury's drawing down by spending cash, and so they're going to have to borrow more. Money supply goes up. That's the thesis briefly behind that call, which I know is a contrarian position.
Yeah, but I think there are so many other factors in play right now. There will be some sort of new economy that emerges. I don't think anyone believes that we're going back to what the old economy was. That will require a lot of capital investment. We're going to see that. And then also, we're in a world where modern monetary theory is a generally accepted practice. So you can delay paying back that debt for a very long period of time now.
Lori, let's talk about the stock side, because the response from Scott and other people on the social media things was basically that if Scott is right, I know Bob disagrees, but if Scott's right, and you should also let me know if you agree or disagree, that equities have nowhere to go but up if yields come back down.
Well, look, I would say I'm actually, maybe a contrarian on both fronts. I'm more in Bob's camp on, where the 10-year is headed. I think there are just a lot of factors to look at. And I do think recessions tend to usher in regime changes. But look, I think that the equity market relationship with yields is a very, very complicated one. And perhaps if we see the 10-year move down, you can reinvigorate sort of the tech side of the trade, and that will technically take markets back up again. I wouldn't necessarily say get out of the way, because I think it would be a very, very narrow trade in some of that old leadership. Frankly, what I've been spending a lot of time talking to investors about the past few weeks is what happens if yields continue to creep higher. And we actually do think that equities can muddle through it. But we do think that it ushers in one of these new regime changes where the more value cyclical oriented parts of the market are going to work. So I would say it's not as simple, perhaps, as Scott, is sort of suggesting.
Shepard Smith here. Thanks for watching CNBC on YouTube.